Hi, everyone. Welcome to our 2025 Midyear Outlook, where we'll discuss stocks, bonds, and the economy for the remainder of this year.
Stay tuned. In January, we wrote that due to tariffs and government spending cuts, we expected volatility. At the same time, we're bullish on stocks, bonds, and the economy. As of this recording, the stock market has been volatile this year. However, we are happy to say that it has been a good year for the economy and overall markets. Let's now look at our outlook for the remainder of the year. Is the economy entering uncharted waters? Maybe, but that's nothing new, as it often feels this way. In the second half of the year, we do believe the effects of the tariffs and trade policy will begin to take a more noticeable toll on the economy, which will likely result in slower growth and perhaps even a modest uptick in inflation. We also think tariff headlines will continue to drive market sentiment. But on a positive note, due to lower corporate tax rates and a more friendly regulatory environment, we think companies will continue to grow their earnings and do well. Looking closer at the impact tariffs may have, as long as businesses are able to find free trade zones, exclusions, and other loopholes to minimize tariff rates, unless those tariff rates surpass 20%, we don't see trade policy being a major factor in increasing the chance of recession. And we think the risk of tariffs surpassing the 20% level is minimal.
Stock market performance will center around trade negotiations, AI, interest rate volatility, and the recent tax bill. Stock valuations reflect a lot of good news amid so much policy uncertainty, but we do believe that volatility is ahead. Given the limited room for multiple expansion, we expect only modest gains by year end. There are several paths to more upside for the stock market. One is unanticipated productivity gains from AI investment. Another is the recent tax bill, which could help lift corporate profits amidst the Trump administration's pro-growth policies. Lower interest rates could also be a tailwind for stocks. If stocks are going to go meaningfully higher in the second half of 2025, earnings will be an important part of the story. And you can't talk about the earnings outlook without the two T's, tariffs and technology. Starting with tariffs, earnings growth in the first quarter for S&P 500 companies was solid at around 13%, with nearly half of that increase coming from big tech. Normally, investors would celebrate these numbers, but they were produced before most of the tariffs went into effect, which is a big question mark going forward as tariffs take hold.
Well, Treasury yields will probably remain in the 4.25% to 4.75% range. A tug of war will exist between economic data and the deficit spending that continues to add to our growing national debt, which is now in excess of $37 trillion. Lastly, we believe it is likely the Federal Reserve will start to lower interest rates later this year, since historically there's a high correlation between Fed fund rates and Treasury yields. We believe bonds are worth owning and will perform well as interest rates eventually fall. This concludes our mid-year outlook. We hope you enjoyed it, and feel free to call us if you have any questions regarding anything we discussed in the video. Thanks for watching, and have a great summer.
Please review these important disclosures.